Okay, so you want to understand how a $7 pizza made a company worth more than most luxury restaurant empires combined. You look at Domino's and you see a pizza chain. You see a red and blue logo, a delivery driver, a cardboard box. Simple, obvious, maybe even a little boring. The business on paper couldn't be more straightforward. You make dough, you put toppings on it, you drive it to someone's house, they give you money, except that's not the business. Not even close. In 2010, if you had taken $1,000 and split it between Google, Apple, and Amazon, the three most obvious investments of that era, your money would have grown into roughly $3,500 by 2020. A solid return. Something to feel good about. That same $1,000 placed into Domino's Pizza would have grown into over $20,000. Not a typo. A pizza chain outperformed the most celebrated technology companies in American history by a factor of nearly 6 to 1 because it isn't pizza. Let's say you want to own a Domino's franchise. You've seen the numbers, you like the brand, and you're ready to write a check. The franchise fee, the upfront payment just for the right to use the name before you've broken a single piece of ground, runs between $900 and $5,000 for a traditional location. That's the number that gets quoted in the brochure. That's the number that sounds almost insultingly reasonable. Then you start reading the fine print. Total initial investment for a standard Domino's location runs between $125,000 and $460,000. Depending on your market, your real estate situation, and whether you're building from scratch or converting an existing space, you need to show Domino's a minimum net worth of $250,000 with at least $75,000 in liquid capital sitting in your account before they'll seriously talk to you. That's the floor. That's the starter. That's the cost of getting into the conversation. And here's what nobody warned you about before you got here. The brand has a very specific opinion about what your kitchen looks like. The conveyorized oven, the dough press, the refrigeration units, the layout of the make line, where toppings go, how the sauce station is positioned relative to the cheese station. All of it, specified, standardized, and non-negotiable. You don't get to improvise the kitchen. You get a blueprint, and you build to the blueprint. Before you've sold a single pizza, you've already committed to a full commercial kitchen build-out, a lease on a commercial space, equipment that meets corporate specification, and a training program that will take several weeks and cost you time and money before a single order is placed. The cheap option isn't actually available to you. It exists on paper, but the markets where it's possible are the markets where you're not going to build the volume you need to make the numbers work. The real entry point, the version worth wanting, is closer to $300,000 minimum. Now you're open. You've got the sign, you've got the kitchen, you've got the app live and orders coming in. This is where most franchisees stop doing math they shouldn't. Domino's collects a royalty fee of 5.5% of your gross sales. Not your profit, your gross sales. Every single week, before you know whether that week was profitable or not, 5.5 cents for every dollar you brought in goes to corporate headquarters. Then there's the advertising fund contribution, another 6% of gross sales. That funds the national campaigns, the promotions, the sponsorships, the app development. Again, off the top. Again, based on gross sales, not on whether you made money. Let's run that out. Say your location does $1.2 million in sales in a year. A reasonable mid-tier number for a Domino's doing decent volume. Hand over 5.5% in royalties, and that's $66,000 gone. Add 6% for the advertising fund, and that's another $72,000. That's $138,000 that has left your bank account before you've paid a single employee, bought a single pound of mozzarella, or paid a single month's rent. You haven't turned the oven on yet, and you've already spent $138,000. Now add labor. Fast food operations typically run labor costs at around 25 to 30% of revenue. At $1.2 million in annual sales, that's somewhere between $300,000 and $360,000 just in wages and payroll taxes. Add your rent. A Domino's occupies roughly 1,000 to 1,200 square feet, and in most markets that's going to run you between $36,000 and $60,000 a year. Add utilities, insurance, supplies, equipment maintenance. By the time you've accounted for every fixed cost, the distance between your gross revenue and your actual profit is much, much smaller than the franchise brochure implied. Here's the thing that nobody explains correctly, and it's the reason Domino's trades more like a technology company than a restaurant chain. The store, your store, the one you own, the one you spent $300,000 opening, is not the core of Domino's business. It is the delivery mechanism. The actual business is sitting one level above you. Domino's Pizza Inc. owns and operates 22 regional dough manufacturing and supply distribution centers across the United States, plus 5 in Canada. These aren't warehouses, they're production facilities. Every day, they manufacture fresh dough that gets delivered to franchise locations across their territory. They sell you the sauce, the cheese, the boxes, the napkins, the dough press supplies, the cleaning products. Over 60% of Domino's total corporate revenue comes from selling ingredients and supplies to its own franchisees. Let that land. The parent company has built a system where the franchisees, the independent operators who took on all the capital risk, all the labor management, all the day-to-day operational stress, are also the parent company's primary customers. You pay them to join, you pay them royalties on your sales, and you pay them for the raw materials you use to generate those sales. The genius of this structure is that it converts what would normally be variable revenue, restaurant sales that go up and down with consumer demand, into something much closer to guaranteed income. Whether your specific location has a good week or a bad week, Domino's collects on the royalty, collects on the advertising fee, and collects on every pound of cheese that came through its distribution network. Now name the core mechanism. The real estate empire beneath fast food built a parallel structure here, but the Domino's version is built around ingredient supply. Franchise royalties are the margin on top. Supply chain sales are the foundation. The corporate level, Domino's generated total revenues of $4.9 billion in fiscal year 2025, with gross profit margins approaching 40%. Those are software company margins. They're not restaurant margins. The payback math for a franchise operator in a favorable scenario runs somewhere between 5 and 8 years. That's assuming consistent volume, no major equipment failures, no dramatic swings in commodity prices, and a market that continues to support the brand's price positioning. The costs are fixed, the revenue is not, and that asymmetry is the central risk that every Domino's franchisee carries every single day. Mozzarella cheese is the single largest ingredient cost in the pizza business. It makes up between 26 and 40% of a pizza's raw food cost, depending on the topping mix. And the price of mozzarella doesn't care about your 5-year business plan. In 2021 and 2022, dairy commodity prices surged as supply chains fractured globally. Mozzarella costs spiked dramatically in a compressed window, squeezing franchisees' margins at exactly the moment when labor costs were also climbing due to widespread worker shortages. A franchise operator with a $1.2 million annual revenue location could watch their net margin compress from a manageable 8 or 9% down to 3 or 4%, not because they did anything wrong, but because 2 commodity prices moved against them simultaneously. They still paid royalties. They still paid the advertising fund. They still paid their lease. And here's the structural insight underneath that. Domino's corporate is partially insulated from commodity volatility in a way that individual franchisees are not. When cheese prices rise, the corporate supply chain division adjusts its supply pricing and continues to operate. The royalty is still collected on gross sales. The franchisee absorbs the squeeze at the unit level. This isn't a criticism of the model, it's how the model is designed. The franchisee takes on operational and commodity risk in exchange for access to the brand system, its technology, its scale, and its purchasing leverage. The corporate entity captures predictable income while sharing the upside of a growing network. Understanding that trade-off is the entire exercise. In 1960, a 23-year-old named Tom Monaghan and his brother James paid $500 as a down payment on a struggling pizza shop called Domino's in Ypsilanti, Michigan. James traded his share of the business for a used Volkswagen Beetle within a year. Tom kept going. He wasn't a culinary visionary, he wasn't a tech entrepreneur, he was a man trying to keep a small business alive by stripping out everything that was costing him money. The dining room went first. It required too much square footage, too much furniture, too much front-of-house staff. He reduced the menu to a single size of pizza to simplify production. He concentrated entirely on delivery. What he stumbled onto by necessity was the fundamental economic advantage of the delivery-only model. A Domino's store needed roughly 1,000 square feet to operate. A traditional pizzeria needed 3,000 to 5,000. Lower rent, lower build-out costs, lower labor overhead, all that reduced the break-even threshold to a level that made individual unit economics dramatically more manageable. But the insight that actually built the empire was the 30-minute guarantee. In 1973, Domino's formalized what had been an informal promise: your pizza arrives in 30 minutes, or it's free. On paper, this sounds like a reckless financial exposure. In practice, it was the most effective marketing device the company ever deployed, because it forced every operational decision inside the business to be made in service of one measurable outcome: speed. The guarantee wasn't a customer perk. It was an engineering constraint. Kitchens had to be laid out to meet it. Staffing had to be scheduled around it. Every process decision flowed from it. It worked for 2 decades. Then it started costing more than it was worth. By the early 90s, the pressure to meet the guarantee had created dangerous incentives for delivery drivers. A 1993 accident resulted in a judgment of $78 million against the company. By the end of that year, the 30-minute guarantee was gone. So here's the question worth sitting with. How does a company built entirely around a promise it can no longer make continue to dominate its market for the next 30 years? The answer is that the guarantee was never the product. It was the signal. The guarantee told customers what Domino's stood for: speed, reliability, the promise that the experience would be consistent. Once customers understood what the brand meant, the guarantee itself became unnecessary. The reputation had already been built, and that is the structural insight. Brand equity, once established, outlives the specific mechanism that created it. By 2008, Domino's had a problem that no amount of operational efficiency could solve. Customers didn't like the pizza, not preferred alternatives. Didn't like it. Consumer focus groups, organized by the company's own research division, produced feedback that is almost painful to read in retrospect. Customers compared the crust to cardboard. They compared the sauce to ketchup. A brand built on speed had lost the thread on the thing it was supposed to be delivering. Customer satisfaction scores had cratered. The brand was increasingly associated with convenience for people who had given up on having good food, not as a choice, but as a resignation. In 2009, incoming CEO Patrick Doyle made a decision that should probably be studied in business schools for a long time. Instead of quietly reformulating the recipe and hoping customers would notice, he launched what the company called the pizza turnaround. Nationally televised advertisements showed actual Domino's executives sitting in a room, watching real customers describe the product in terms that were genuinely unflattering. No spin, no reframing. Straight footage of people saying the food was bad, and then executives acknowledging they were right. The company overhauled everything: the dough formula, the sauce recipe, the cheese blend. Then they ran the ads showing the process and daring customers to try the new product. In the first quarter of 2010, domestic same-store sales jumped 14.3%, the largest single-quarter gain in fast food history. The stock rose 44% in the month following the campaign launch. Here's the structural observation. Transparency worked not because customers are naive, but because brands almost never actually do it. The entire marketing landscape runs on defensiveness. Companies spinning problems, minimizing complaints, issuing measured statements. When a brand sits in front of a camera and says, "You're right, we failed, here's what we did about it," the shock of the honesty does more reputational work than any positive campaign. Radical transparency, executed at the right moment, is one of the most undervalued assets in brand management. Domino's proved it with numbers. If you're finding this breakdown valuable, and there's a lot more to cover, this is a good moment to subscribe and hit the like button. It helps this channel reach more people who want to understand how businesses actually work, not just how they appear to. In 2008, the same year the product crisis was peaking, Domino's made a parallel decision that would define the next 15 years of its business. It began building its own software. Most restaurant chains of that era outsourced their digital infrastructure. Point-of-sale systems, online ordering platforms, customer apps, all of it contracted to third-party vendors, which meant every feature upgrade was a negotiation, every data insight was filtered through someone else's system, and every customer interaction generated data that ultimately lived in someone else's database. Domino's decided to build in-house. It hired software engineers. It started thinking of its app not as a convenience feature but as a core operational asset. The Pizza Tracker launched in 2008, a real-time status system that let customers watch their order move through the preparation and delivery process. On the surface, it's a nice customer experience feature. Underneath, it solved a real operational problem. Store phone lines were constantly occupied with customers calling to ask where their order was. The tracker eliminated the call. It also incidentally made the wait feel shorter, because progress feels faster than waiting. By the mid-2010s, Domino's could accept orders through its app, its website, smart televisions, text message, and eventually voice assistants. An AI-driven voice ordering system called Dom was handling nearly a quarter of all U.S. phone orders by the late 2010s, reducing store labor costs on order intake without adding headcount. Digital sales channels now account for over 85% of total U.S. retail sales. And here's why that matters beyond the convenience story. Every digital order bypasses third-party delivery platforms. When a customer orders through the Domino's app, the company pays zero commission to DoorDash or Uber Eats. On a typical delivery aggregator, that commission runs between 50 and 30% of the order value. On 85% of all orders, Domino's keeps that margin entirely. At $1 billion in annual sales, the math on platform independence is worth hundreds of millions of dollars a year. Domino's didn't build this technology infrastructure because it was feeling ambitious. It built it because the alternative was losing. Pizza Hut was the dominant pizza chain in America for most of the 1980s and 1990s. It had more stores, higher brand recognition, and a sit-down model that seemed more premium. Papa John's was growing aggressively through the 90s with a better ingredients, better pizza positioning that directly challenged Domino's on quality. Local independents competed on every block. The delivery aggregator threat arrived later, DoorDash, Uber Eats, Grubhub, and it was potentially the most dangerous competitive development in Domino's history. These platforms didn't just compete for orders, they competed for the customer relationship itself. When a customer orders through an aggregator, the restaurant becomes a commodity. The platform owns the interface, the data, and the reorder relationship. The restaurant is just a kitchen. Domino's recognized this early enough to respond. By building its own ordering technology, accumulating its own customer data, and investing aggressively in direct digital relationships before the aggregators reached critical mass, the company protected the most valuable thing it owned, the direct line to its customers. Every customer who orders through the Domino's app instead of an aggregator is worth more, not just because of the avoided commission, but because the data from that order stays inside Domino's system, feeding the predictive models that make the next delivery faster and the next promotion more precisely targeted. The carry-out segment was another deliberate hedge. As delivery competition intensified, Domino's leaned into carry-out promotions. Its $7 carry-out deal became one of the most recognized value propositions in fast food. Carry-out orders carry higher margins than delivery orders, with zero driver cost and zero fuel expense. Expanding carry-out share gave the company a buffer against delivery market disruption that pure delivery chains simply didn't have. Here is where the model becomes something genuinely unusual. Domino's operates 22 regional dough manufacturing facilities across the United States. These plants produce fresh dough daily. They also process vegetables, manage cold chain distribution, and supply franchise locations with essentially everything they need to operate. Sauce, cheese, boxes, cleaning supplies, equipment. This supply chain is not just a cost center, it is a profit center, and it is the single largest revenue source in the entire Domino's corporate structure. When a franchisee buys dough from the corporate distribution system, they pay